Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello and welcome to Reverse Mortgage Radio. Today we're going to delve into a bit of reverse mortgage history, and we're going to talk about how in the world did reverse mortgages get such a bad rap, and why has it not changed? I know I'm being a little melodramatic here for your weekend, but that's the way I feel, because looking back on the history of reverse mortgages and the fact that I've been a big part of this history over the last 21 years of reverse mortgages, I pull my hair out sometimes as to what is going on, why so many people still won't even give reverse mortgages a first look, let alone a second or third look. And it's because they've got these preconceived notions about it. I mean, I know we've talked about misconceptions, how, it's only for desperate people. That's probably the worst misconception, because that is not the case. However, you'll see as we go into the history that was the case for the beginning when it first started out. So what I've done is I've broken reverse mortgage history down into three different time frames. We've got what I call the Wild West, 1961 to 1988. Yeah, 1961 is how far this loan program dates back. Then we've got BFA. And it's not, the F isn't what you think. That's before financial assessment. That time period is 1989 to 2014, and really the kind of bad stuff happened from 2007 to 2014 timeframe. And we'll talk about that, because really there was kind of a golden time period in that 1989 to 2005-6 timeframe before the financial meltdown in 2008 and before, we'll get into that. Then I've got AFA, the after financial assessment. And that I've broken down into basically three big rule changes and one formula change. So you ready to dig in? Thank you so much again for joining me. My name is Bruce Simmons, and you are listening to Reverse Mortgage Radio. My phone number, if you have any questions, is 303-467-7821. 303-467-7821 is my direct line. And this podcast will be up on my website come Tuesday, usually. Tuesday or Wednesday is when my web guy usually gets it up on the site. And that is at reversemortgageradio.net. reversemortgageradio.net is my website. You can go there. You can download my consumer guide, my reverse mortgage consumer guide. I'm working on getting it updated. I know I should start working on it in like October, November of last year. And here we are in the spring of this year, and I still haven't updated it yet. But that's okay, because there's a lot of great information in it already the way it is. Very subtle changes have happened that I need to update is all it is. And I'm probably going to shorten it as well. But either way, there's great information at reversemortgageradio.net, and it's my reverse mortgage consumer guide. All right, let's jump in. In 1961 is when our story begins. And it begins with a banker by the name of Nelson Haynes. And what he did, he worked for Dearborn Saving and Loan in Portland, Maine. He created the very first reverse mortgage loan. He did it for Nellie Young, who was the widowed wife of his high school football coach. And he did it so she could stay in her home after Coach died. She didn't have the money, and she needed to figure out how to stay in the home. So what Nelson did is he figured out a way to say, okay, we're going to forego a little bit of interest here right now for more interest in the future. And we're going to loan you money based on the equity in your home. Essentially, that's all a reverse mortgage is, right? But then what happened is problems kind of occurred in the 60s and throughout the 70s and into the 80s because there were not a lot of regulations back then on reverse mortgages or mortgages generally. And as you know, I'm sure, elderly people are targeted by scumbags who want to try to take advantage of them. And you don't want to be one of those poor people that gets taken advantage of. That happened to my dad, actually. He lost $4,000 on one of these scams. And he was a smart guy. It wasn't like he was some idiot or feeble old man. He was still golfing every day and very active. I think he was only in his early 70s when somebody fooled him and took $4,000 of his hard-earned money. But anyways, what would happen though too is reverse mortgage kind of got conflated with what is equity sharing programs. So back in the 70s, equity sharing was kind of popular, and a lot of people just assumed that reverse mortgages and equity sharing were kind of the same thing. For example, when I started in this business in 2003, I remember an article came out in the San Francisco Chronicle or some newspaper in the Bay Area because she had passed away with a reverse mortgage on her home. And as you read the article, it said that basically over the course of about 25 years, this lady took out her loan in 1988. Remember that time frame, 1988. And she passed away in 2003, 25 years later. But what happened over that year, she was receiving a monthly payment. And she received, over the course of that 25 years, she withdrew roughly about $80,000. At the time in 1988, her home was worth about $150,000 in the Bay Area. And in 2003, the home was worth, I can't remember exactly, $500,000 to $600,000. The headline, though, was something to the effect that 89-year-old woman dies with reverse mortgage owing more than 3 times the amount she borrowed. How did that happen? She took out about $80,000 and she ended up owing about $250,000 on this $500,000 or $600,000 home. Well, as you read the article, the lender actually had an equity sharing agreement in the contract. So this really wasn't even a reverse mortgage. It was an equity sharing scheme. And that equity sharing was like 30 or 40% of the appreciation. So her home appreciated by about $450,000 if it was worth $600,000. And if he took $30,000, if the lender took $30,000 of that, that's like $130,000 right there. And then there was about $50,000 worth of interest that accumulated over the 25 years, and then her $80,000. But the headline was that reverse mortgages are a scam, basically. That's how people read this. I looked at that, I'm like, holy cow. Now, wait a minute, though. 1988. What happened in 1989 that changed the program? Well, that takes us to the next section of time for our reverse mortgage history lesson here. 1989 to 2014. In 1988, Ronald Reagan signed the bill. I think it was the Housing and Community Development Act. And that law, part of that law allowed FHA to insure the reverse mortgage program called the Home Equity Conversion Mortgage. And the home equity conversion mortgage is the FHA insured reverse mortgage loan program. FHA stands for Federal Housing Administration, and HECM is the acronym for the Home Equity Conversion Mortgage. And essentially what that program is it's a loan that allows people who are 62 and over to convert a portion of the value of your home into money that you can spend. You can take it out as a monthly payment, like that little lady in San Francisco. You can receive a lump sum with restrictions now. That's one of the rules that we're going to talk about in the next section. You can also set up a line of credit and just draw money out whenever you need it, or you could do a combination of all three. Any existing loan that's on the home has to be paid off first. And then whatever is left over is available to you to draw out in one of those options that we just discussed. Now, a big, huge part of the loan program is that the house is still yours. The bank does not take your house. They don't take title to it or anything. However, since it's still your house and you have no mortgage payment now, no required monthly payment, that's a big benefit of the reverse mortgage. It's still your responsibility to pay your own property taxes, homeowners insurance, and maintain the home. You also have to live there as your primary residence and keep your name on title. But as long as you do those 5 things, that's the caveat, you can never, ever, ever lose the home. Well, what happened in between 1989 and 2014, roughly around 2005-06 time period, the subprime market, as you know, that was pretty much in the early 2000s to about 2008. In 2005, 6, and 7, savvy loan officers who were doing these subprime loans and not being totally ethical with them, obviously, as we now know in hindsight, they felt the ground started to shift underneath their feet because they saw the trends were changing a bit. And they heard about reverse mortgages. Hey, reverse mortgages were even easier than the subprime stuff. You didn't have to lie on the application because no income was required for the reverse mortgage at that time. There was no financial assessment. Remember, this is BFA, before financial assessment. So there was no income. We didn't care about your credit either. And so you could be in foreclosure and get a reverse mortgage, even if you didn't have any money to make a payment, because no payment was required, right? But what they didn't do, from the beginning of my career, I had a very, very good mentor, and she told me from the beginning, you have to tell people that they're responsible to pay their own taxes and insurance. Well, back in 1989 to 2005 timeframe, a lot of those, probably half or more of those homeowners who took reverse mortgages were people that own their home free and clear. They're used to paying their own property taxes and insurance. When a lot of these subprime guys got in the business, they started soliciting people who had existing mortgages as a benefit. Hey, let's pay off your mortgage and you have no mortgage payment. And yeah, that's a great benefit of the reverse mortgage. But what they didn't say is that you still are responsible and must pay your property taxes and homeowners insurance. At that time, there was no set aside. We didn't even have the option to set aside money to pay your taxes and insurance for you. Now, granted, everybody who took out a reverse mortgage, no matter when they took it out, there's paperwork that they sign that says you are responsible as the homeowner to pay your own property taxes and insurance. But the problem is the stack of paper is 3 inches thick that we have people sign, right? Not quite. That's a bit of an exaggeration, but it's a huge stack of paper. It's even worse now. But that's one of the forms that you sign. But unless it's emphasized to people, they're not going to remember. In fact, I've done closings where, in fact, I got a clear to close this week, and I sat down and I explained to the homeowner, okay, your property taxes are $2,400 a year. Your insurance is $2,000 a year. Together, that's $4,400 divided by 12. That's $380 a month, something like that, whatever the case is. And you have to save that amount. So you have to set up your own escrow account. And what I told her is you're going to get about $1,200 back from the current escrow balance that you have with your current mortgage. Take that money, open up a separate savings account, completely isolated from any other programs you have. And then you let your bank know you want $380 a month taken out of your checking account after you get your Social Security and deposited in that savings account. And that's all that savings account is for. When your property taxes come due, boom, that money's there and you take it out and you pay it. When your homeowner's insurance comes due, boom, you take it out and you pay it. Or you can even set up your homeowner's insurance to take it out of your bank account automatically every month. But anyways, it's very important that you do this. And that was not emphasized by a lot of these guys who were just out to make a quick buck, in all honesty. The program worked exactly as it should. It paid off the people's reverse mortgage, and it gave them additional money. Okay, or excuse me, it paid off their existing mortgage, got them out from under that mortgage payment, and it gave them additional money in a lot of cases. However, they just did not pay attention, or the loan officer was not upfront enough about the fact that the homeowner still had to pay their taxes and insurance. So if you've got a $1,500 mortgage payment, and that includes your property insurance and taxes, and your property insurance and taxes are $400 a month, you're really only saving $1,100 a month when we pay off your mortgage, because that other $400 has to go to pay your taxes and insurance. So that issue, combined with the fact that up until about 2007, all reverse mortgages were adjustable rates, right? They're all adjustable rates. So people could take the money out as lines of credit or monthly payments or a combination. Or all in a lump sum if they wanted, but very, very, very few people took it all in a lump sum. And so what would happen is in 2007, when the fixed rate came out, well, fixed rates require you to pull all the money in one lump sum. There is no line of credit option. There is no monthly payment option. You have to take all or nothing. And what would happen is these people would take out this money, pay off an existing mortgage, and maybe they still have $50,000 or $100,000 left over. They would blow it in the matter of a couple of years because they weren't used to having that much money handy. They'd have pariah kids that would take it, or they would spend it on lavish trips that they really shouldn't have taken. Things of that nature. You know, some nephew or a grandchild that had a drug habit who would take money, swindle them out of money, all these different factors. And so they would run out of money. They didn't know they were supposed to pay their taxes and insurance. The taxes and insurance came due. They didn't have any money. And what would happen? They got foreclosed on. Why did they get foreclosed on? Because they had a reverse mortgage, right? No, that's not the reason they lost their home. They lost their home because they did not pay their property taxes. That's the reason. And if they owned their home free and clear and they didn't pay their taxes, they would have lost their home anyway. And sometimes we would loan money to people. I say we, I didn't really, it's mainly this group of people, because I had already developed a good referral base at that time, working for a big bank, and I very seldom dealt with super desperate people. But anyways, these people would come to somebody for a reverse mortgage knowing that they really couldn't afford to live in that home. They should have sold the home because they're living on Social Security, getting $2,000 a month, and their property taxes are $1,500 a year. They've got, $30,000 in credit card debt, and they've got homeowners insurance and everything else too, and they really could not afford to stay in that home. They should have sold it. But what the reverse mortgage did is it allowed them a couple extra years to live in the home. So anyways, that was what happened. And so we were just kind of in the early 90s and early 2000s, we were getting out away from that equity sharing scam stuff in the 70s and 80s that was going on. And we were rebuilding our reputation as an industry. And then 2008 happened, and then the property values tanked as well. So people were upside down on their home. Now, granted, there was mortgage insurance, and mortgage insurance protects the lender. It protects the lender, so the lender's not going to lose any money. So the lender can't come after the homeowner for any losses. But still, there were a fair number of people in their 70s and 80s that got foreclosed on and evicted. And that's never good news when grandma's sitting on the sidewalk with her belongings from her house that she lived in for 40 years, right? That's bad business, bad press. And they jumped on it and took advantage of it. Now, granted, most of the people were very satisfied with their reverse mortgages. In fact, a study done in 2010 by the National Reverse Mortgage Lenders Association of 600 seniors with reverse mortgages found that close to 80% reported satisfaction with their reverse mortgage. on a scale of above a scale of 6 on a scale of 1 to 10, with 10 being the highest. And 43% of those people surveyed gave a 10. Perfect rating. And then in 2016, a survey funded by the MacArthur Foundation of 1,761 households also showed 83% of seniors were satisfied or highly satisfied with their reverse mortgages. And then a study in 2020 by the Journal of Gerontology that surveyed 1,088 older homeowners. This is interesting. They found that seniors with a reverse mortgage had a higher housing and life satisfaction rate than seniors without reverse mortgages. They were more comfortable and confident in their ability to stay in their home and age in place. So it's been a very, very good program. But what happened, it was kind of a perfect storm. We had the fixed rate come out that required people to draw money all in one lump sum. We had a bunch of people come into the industry without the best moral standards or ethics. We also had the 2008 housing crisis, and all those combined basically kicked us in the rear and gave us this bad reputation, which was deserved in some respects, because we let these scumbags into the business, and now they're all gone. And especially now, after rates the way they've been the last few years have weeded out even more so-so loan officers that aren't really professionals, if you will. By the way, too, if you just tuned in, you are listening to Reverse Mortgage Radio. My name is Bruce Simmons. I'm the Reverse Mortgage Manager for American Liberty Mortgage in Denver. You can reach me directly with any questions at 303-467-7821, 303-467-7821, or visit me online at reversemortgageradio.net. reversemortgageradio.net. Next week, if you missed it and you just tuned in and you're thinking, oh, darn, I missed all this great information that Bruce gave me, you can go to my website next week and at reversemortgageradio.net, click in the upper right-hand corner on Reverse Mortgage Radio Show, and you can find the podcast. In fact, you can go back to 2017. I've got all these podcasts from 2017 on about reverse mortgages. So let's get into now the segment of time that we're in with reverse mortgages. And that I say 2015 to current. Really, it goes back to 2000. We can go back to 2013. I mean, we've had some big rule changes. Well, number one, we've reduced the amount of money we allow people to borrow. It's called the principal limit factor. So back in the mid 2000s, we were loaning 60 and 70% of the value of people's homes to them. And then, of course, we got slapped in the face when the values dropped and people were all upside down on their house. Now, that didn't hurt them as long as they paid their taxes and insurance and they were just staying there. I mean, it didn't change anything. In fact, I did a loan for somebody. I refinanced their loan in 2017, and they told me in 2008 they were upside down on their house. But then between 2008 and 2017, their value grew so much, it went way beyond the amount owed, and we were able to refinance them in 2017 and give them more money. So anyways, but what happened, there were some big rule changes. Number one, in 2014, there was something called the non-borrowing spouse rule. Before this time, if you were married to somebody, let's say somebody was 75, you were married to somebody 75 and you were 55. The 75-year-old could get a reverse mortgage. They would do it without your name on the loan. But then when the 75-year-old died and you were still in the house, the loan came due. And you either had to sell the house or refinance it. And a lot of people got stuck. They couldn't handle that. They didn't have the money to qualify for a new loan, and they ended up having to sell, or they got foreclosed on. So we created something called a non-borrowing spouse rule, where you can stay in the home now. It allows younger homeowners to stay in the home, even though they don't really qualify to be a borrower. And I've done whole shows on that in the past. Go to reversemortgageradio.net to check it out. Also, another rule was financial assessment. This is where we required now, at this point, you had to have decent credit and you had to show that you had the income to be able to afford to stay in your home. Of course, if you don't have decent credit, we now also can do something called a life expectancy set aside, where we take money away from the loan proceeds and set them aside and pay your taxes and insurance on your behalf. You're not charged interest until we actually pay those costs out, though. That was a huge one. That has made such a difference, and it really helped improve the status of reverse mortgages. Not as good as we like, but we're on the way. Okay. Another rule in 2018 happened called collateral risk assessment. This is where FHA reviews every single appraisal that's done for a home equity conversion mortgage. It goes through this AVM. It's called an appraisal valuation model. And if certain algorithms in this computer model don't match what FHA thinks they should, they can spit it out and say, we want a second appraisal. And it is a pain in the butt. But it is probably for the best. It is, I'm going to say it's for the best, even though I'm reserved. I've had it be problems. But actually, in the long run, it's best because we don't want to loan more on the house than the house is actually worth. And it helps people retain their value. Retain their equity, I should say. Also, too, in 2017, there was a huge change to the principal limit factor where the FHA lowered the amount of money we could loan to people by 20%. 20%. So, in other words, if you could get $200,000 before October of 2017, you could only get, $160,000 in October 1 of 2017, okay? Or I think the change happened October 2nd. So, it dramatically reduced the amount of money that we can loan to people, which it was okay because interest rates dropped so much that it didn't affect us for a long time, but now it is. It's a huge problem now as to the fact that we can't loan as much as we would like to now. It's actually not good at all right now. But I think rates fluctuate. They're going to go up, they're going to go down, and we have to deal with what we have. But if a reverse mortgage makes sense for you now and it gives you enough money to pay off your existing mortgage or gives you the money for the line of credit you want, do it now. And possibly, if rates drop in the future, it's possible that we might be able to refinance your loan down the road and get you more money. I always say, if it makes sense today, do it today, especially if we're paying off an existing mortgage and you can save that principal and interest payment. But remember, you do have to pay your own property taxes and insurance. Don't forget that. I want to thank you for joining me again. My name is Bruce Simmons. I'm the reverse mortgage manager with American Liberty Mortgage in Denver. And my number is 303-467-7821. Hopefully you've enjoyed this little flashback to history dating back to 1981 to 1988, where it was the Wild West. And then, of course, in 89 to 2014, where it was BFA, before financial assessment, and 2015, which was basically the regulation time periods where we had these big changes, AFA, after financial assessment. But that was just one of the regulations that have gone into effect. But also visit me online. If you missed any of the show, I'd love to have you go download my podcast and listen to that at reversemortgageradio.net. reversemortgageradio.net. Thanks so much, and I hope you have a fantastic day.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821, or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.